Thanks, Fifi, for the introduction. I won't go into a second introduction of the panel team, so we'll build on some of the points that Abel made. Is obviously we're in a very interesting transition period in our country. After the formation of the GNU last year, we had a significant rally in, let's say, the SA domestic stocks, most of that driven by local investors. We haven't really seen the foreign investors come back into the country like we did previously with Ramaphoria. And, so we're starting to look at what does SA need to do, what does the market need to do to attract those foreign investors and get them back into SA and thinking about SA, because it does have a great self-help story, but we haven't seen them participate. So I'll start with you, Delphine. What do you think we need to see in order to get them back in the market here?
Sure. Thanks, Matt. And morning, everybody. It's great to be here. Thanks to the JSE. I think it's pretty simply put, particularly because, as South African investors, we are somewhat trapped, and we do have a bit of a home bias in the sense that we look for opportunities, even if the story isn't as compelling. Global investors are a lot more discriminate because they just have such a large universe to pick from. And to be honest, if I had to think of all my engagements with global investors, the single thing they look for is the G word, and it's growth. And so ultimately, what they're looking for is if the structural story of the economy is not one of offering that growth story for multiple reasons, and I'm sure we're going to discuss that a little, then they look to the underlying industries or the underlying companies and the underlying management teams all the way down to say, well, what's your story? What's your case for how you're going to unpack growth in this company, in this sector, in this industry, in this within the constraints of the economy? And it's really interesting because when we look at individual case examples, and if we take a sector that is well known to all, like the retail sector, why is it that a company like ShopRite and Mr. Price and perhaps even Foschini Group to some extent, they tend to attract a higher percentage of global investors compared to other retailers? And let's take Truworths as an example at this point in time. And it's really because one management team has been able to articulate a growth story even in a constrained macroeconomic universe or macroeconomic construct that the other management team is just not able to. And that's got to do with the strategy of the company, the intrinsic vision of the company and the mission. So the truth is that global investors, and we've seen a few more of them coming to look, see, and decide, particularly in the post-June and July last year, but still they're looking for those nuggets and those stories. If you look at like a stock like Capitec, that's not valued like a bank right now, it's valued like a growth stock. And there are not that many other stocks in the market that are valued like growth stocks. And global investors really scour the universe, in my opinion, looking for that, perhaps to a greater extent than domestic investors, because we know we have this very structurally different element. So I would say the companies that have management teams that are at least offering a compelling investment case, even with a constrained environment, are still going to attract the relative capital.
Thanks. Kabela, you look like you wanted to add to that, or?
No, I think that's
okay. So look, the other thing we've spoken about Reg 28 for a number of years.
Can I jump in there?
Yeah. Sure.
Sorry. Thanks everybody for having me. I think also another thing to think about, as Delphine touched on, is that we've also been through a period of US exceptionalism at the moment. So looking at an international investor from their perspective, the EM story at the moment is looking a little bit strained, particularly with the politics in the US, etc. So I think, from an unbiased point of view, I think that has also been a headwind for seeing more foreign investment into the JSE. And I think a lot of what we saw post-GNU was local investors buying into the story. As we know, equity markets by nature are forward-looking. So I think a lot of locals were more pumped up, believed the story, invested back into SA. I think foreigners, given with the politics, given all the other issues, given the lack of growth, have stood on the sidelines and really watched. And I think what we're seeing now this year is a little bit of indigestion in the sentiment, etc. The growth has yet to come through. Interest rates are falling, but that impact on the consumer hasn't really become evident yet. So I think maybe, hopefully, into this year, we start to see earnings growth in the local market start improving. Some of that growth, some of the rail reform, we've heard from Transnet, what's happening on that front. From what we hear from Grindrod, there's multiple projects coming through, etc. So I think there's a delay in it, really. And I think only when the actual reality hits the road, where the rubber hits the road, and you actually start seeing growth in the local economy, then perhaps will international investors start coming back into the SA market, and hopefully at the same time, the US equity market also maybe stutters. We saw last night NVIDIA's earnings being a little bit muted. So when that story is off the table, then global investors are also going to be looking for other opportunities. So.
Yeah, we've certainly seen them engage more
Yeah.
with our analysts and engage more in the market and do more of the work. But I agree with you, it feels like they're waiting for some tangible evidence before they actually pull the trigger. On Reg 28, we've spoken about it at length, so I'm not going to go into more detail, but when the initial, let's say, announcement of changes came through, we saw a shift in portfolios. I think it peaked at around 42%, where in sort of some of the balanced portfolios, it's come down to about 36% currently. Kabelo, what do you think? I mean, I know you guys are regulated in terms of what you can invest offshore, but what do you think is the optimal, let's say, offshore investment? And do you think SA asset managers have an edge when it comes to investing globally? You know, what are your views on that?
Yeah, I think if you look at the experience, especially on the Reg 28 change to allow a foreign investment of up to 45%, I think what was very clear across all the asset managers was that potentially that allocation was a bit too high because it caused a massive disruption within our local equity managers. So if you were an asset manager where your business was largely equities, you've had the number of stocks on the JSE decline over the last 15, 20 years. So your opportunity set has shrunk. You also had a situation where if you had built a business that was largely focused on only local equities, you lost half your assets. And you are now competing globally with the large players who came into our market, which caused a lot of disruptions. I think we are seeing it largely on your smaller boutique managers. So if your AUM is lower than 50 billion, those are struggling. I think you would have had it even from the likes of 91, even with their large AUM, complaining that they can't compete with your likes of your BlackRock and all these large global players. So is 45% ideal? I think for me, that horse is bolted. So we need to now move on and rather focus on building global capabilities at home. So a typical analyst maybe 20 years ago was somebody with a CA or maybe a CFA focusing largely on domestic stocks. You had a choice. Currently, you will not do well if we do not build global analysts who understand stocks across the globe. But they have to be based in Cape Town, in Joburg, or in Pretoria as well. So our view at the PIC is that we want to make sure that we become a catalyst for that change. Otherwise, we will have an industry that's going to be in a perpetual decline. So 45%, we wish it could be slightly lower. I think the modeling that we used to do 10, 15 years ago was a number between closer to 35%, and then you can add maybe 5% to Africa. But there is no point arguing about 5%. I think what we need to do as South Africans and as the industry is to make sure that we don't build or create analysts who are just only focused on local knowledge of stocks, but we need to increase breadth. I think for us as allocators, but also as a company that also manages money internally, what I'm doing at the PIC is that we want to create or build our own internal capabilities to manage global at home, but also where we allocate the likes of your Perpetua and other managers who may have there are those who have proven track record in managing global money, so we need to allocate more to them, but there are others who don't have those capabilities. So where we need to create incubation or support it, I think we need to be the catalyst to do it. So, yeah.
Thanks.
Could I add something?
Yeah, sure.
So, I think Kabelo's right on. So there's no magic number, I think, relative to the 45%. And the reality is because your return objective is what's critical. So the typical Regulation 28 fund typically targets CPI plus 5. And in truth, we have to be honest, on every single historic return objective, unhedged global equities gives you the highest real return.
Yes.
So the higher the contribution is just, statistically, numerically, that is going to optimize your return most. But now, obviously, we have to deal with the currency volatility. The reality is that for all of those business reasons and other structural reasons, there were other reasons the 45% perhaps was not as palatable. But our sense is that if you want to optimize it and you want to target, it's all about time horizon, whether you're going to hedge the currency volatility and then your return target. But one should be very comfortable sitting between 40 to 45%. Yeah. And then if I could just add to the second point, I completely get that and completely concede that the South African market, and hopefully, the point of today is to say, how do we grow our South African domestic equity market, as opposed to it being the one directional, which Abel spoke about, which has been shrinking. But any firm that had started, including ours in the last decade, could have seen your right to win could not just be in domestic equities because of the shrinking nature, and it's overtraded. So in fact, there's 150 odd, or I don't even know how many fund managers, all hotly competing for this kind of not growing defensive asset pool, and your side can see it on the sell side. And the reality is that, and it's still heavily concentrated, and we'll speak about that. So one of the questions we often get is, what is it that a fund manager in Cape Town can bring, to the analysis of global equities? Like, what can you bring? Because surely you're stuck in a little market on the, tip of Africa. How are you going to compete with analysts sitting in China and Japan and Boston and, and San Francisco? And it's interesting because one thing we need to do, is Abel spoke about, maybe believing in our own beauty. Yeah. The exact thing that is our identifier, which is that we bring an emerging market lens to investing, is the thing that is the edge that we bring. So what does that mean? Our market is dominated by cyclical stocks, and we'll talk about that later. Our market is dominated by multinationals, rand hedge stocks that sit in this market. Our market is dominated by consumer discretionary, by financials, by commodities. We understand that stuff. Our market, we understand the structure of how the domestic consumer and the multinational consumer. We understand young consumers in a market and aspirational. We understand the formalization of industries. If you just take the drugstore retail industry, why did Clicks and Dis-Chem both do well? Because we had a corporatization. So I guess my point is that there's a lot that is the hidden assets that South African investors own. We've just always pushed it through a lens that's been looking at it into a domestic market. Yes. But that domestic market has brought us natural edges. All we're doing now, and investing is a competence that has no boundaries, is we're applying it to a bigger universe. And so the skill is now, how do you narrow that universe to a noble universe that you as a fund manager can have an edge in?
Yeah, Matt, if I can jump in as well. I think a challenge for the allocators going forward is going to be to try and disentangle global equity return from currency depreciation, and really to just distill what is skill in the local manager market or peer set, and what is being driven just by rand depreciation, because I think those are two specific things. And I think over time the allocators as a whole are also going to have to get smarter at looking at that and saying, okay, because as Abel said, local managers have to compete on a fair playing field relative to global allocators. I mean, SA clients can take money offshore and can allocate it to a global asset manager as well. There's no reason that they have to allocate it to a 91 or an Ashburton or anybody else for that matter. Right. So that's going to be key as well, and I think it's going to be something that will evolve, and clients will get smarter at that. So those that are providing the service are going to have to provide value for money, I think, in my mind.
Yeah, I mean, let's talk about a bit of that concentration risk, because the market this year, performance has been driven by a very narrow sector of the market. If you think about it, gold, Richmond, Naspers until this week, some of the telco names. But there is definitely concentration in our market. With that comes obviously opportunity, but if you weigh that against where the narrow performances come from versus where the SA domestic names have potentially come off a bit, the retailers, banks, everything, there might be quite a wide divergence in performance versus what the index is telling you. How do you guys as managers, look at that concentration risk in terms of the index and what you benchmarked against, and how do you manage that risk and that opportunity when you think about the remainder of the year and how you manage your portfolios at large? I don't know, Delphine, it's,
Okay.
you can give it a go.
Sure, I'll kick off. So 100%. So, and the risk actually exists, so the concentration, it's not even a risk, it's a concentration reality, I'd say. It exists on two levels. The buy side itself is heavily concentrated, so very big chunk of assets sits in the hands of few managers. And then we've got this like long tail, as Kabela mentioned, of like subscale managers. And then that in itself kind of doubles up the second reality, which is because of the way that just the maths work and the assets sit in the hands of few, they can therefore only invest in certain stocks because of their scale. And as we know, 25 shares of the J433, which is this CapSwix, 25 shares account for 70% of that index. And guess what? Those big managers can therefore really only deliver edge playing in those 25 shares. It's not my belief, it's a fact. It's because of how the numbers work, because they cannot get big chunks of their portfolio into shares. And I think, you hit 1% of the index around share number 30 or something. Yeah. So the next kind of 50 odd shares down up to like share 80 is then another 25%. So you've got, the first 80 shares out of the 120 stock index that are sitting in 80 shares, but actually only 25 or 70%. And then that bottom, I think 40 are just 3.5%. 40 stocks are 3.5% of the entire index. So this concentration is a reality. And so what happens is that your large managers can absolutely deliver outperformance, but the quantum of their outperformance is absolutely compressed to their ability to pick overweights and underweights in those top 25. It's just the way it's going to work. And so, why is it that we have this long tail of managers, and why is it that when you look at the performance tables, actually, it's not your big guys that are necessarily giving you the highest percentage of alpha, it's the next level down, is because we are able to combine kind of smart mispricing in the mid caps, particularly in that next 20%, which are still highly liquid. They just, the reality is, if the flows are not going into the shares that are in that next 25, your price discovery is significantly worse. It's not a surprise that those stocks are delivering often better earnings growth, more superior dividend yields, and then they're trading at 10 times earnings because flows are not going there. And so for us, it's exciting. It creates a massive opportunity. It means that for clients that are actually understanding, well, maybe there are cheaper ways of accessing beta in the market rather than an active manager who's giving me the index return. And once they start to see that, it's necessary, just like it's necessary for us to have small and mid caps, it's necessary for us to have different sizes of buy-side managers who can combine difference into their portfolio to bring the alpha. Large businesses are really good at preserving alpha, and growing businesses are really good at generating alpha, which is how the large businesses became large.
Yeah. Maybe just to add, so I'm going to just take it just one level up. So from our side, our AUM is now 3 trillion rand. And out of that, about 95% is in listed markets. You could think about split almost equally between equities and fixed income assets. So we are obviously large, and we typically own anywhere between largely about 15% of every share that is listed on the stock exchange. So how do we extract alpha? We realize that our market is, especially on the top 40 side, is largely efficient. So we run an enhanced active strategy there. Where we are searching for alpha, where we cannot reach it ourselves, that's where we use other managers who are smaller, they are more nimbler, they can move a lot quicker than us to extract a lot of, let's say, a small cap premium or any other premium that we can pick up at the top. So, but given the size of our fund, it's important for us to also go global. So the global diversification strategy from our side continues to increase. We have just allocated capital to the EM side, but largely on the east. We are not looking at Latin America yet, but India, China, we've actually just put quite a lot of capital behind China in the last 3 months, but we are also looking at India as well, and also Malaysia and Indonesia. So because of our size, you're forced to search for alpha in other areas through diversification. We are not at 45% because we are not a Reg 28 fund. We have our own act, so we are only at about 12% on offshore. The other key area where we want to extract alpha from, given what has happened on the listed side, it's on the private markets. So if they are delistings, we have an opportunity to either stay on in that company. We have done it with one, but others, if there's a delisting and the premium is just too high, we take the capital and we invest it largely on the private market side. So if I look at our book and where I've been spending a lot of my time, I'd say Africa, the activity in Africa in the last year on the private market side has been quite a lot. I think we had a fund which we deployed. It was a 5-year commitment fund. Within 2 years, we finished all the capital. And if we look at the returns that are coming from that part of the book, is actually a lot better than we expected. So that's one. And at home, I think we haven't seen a lot of deal activity that that makes sense for us. So a lot of the action has been outside at home. But yeah, I think that's our sort of overall allocation strategy. Within the listed equity, as we sit today, so we have been, I think we've missed Richmond. We were slightly underweight Richmond, but Naspers we were always at a large overweight. We do like the valuations that we are seeing in Chinese tech. We don't like what's happening in the US. We think there is overvaluation there. So like I said, last year we took a deliberate effort to increase our China exposure, but largely Chinese tech, because we do think at some point valuations will matter. And we are starting to see that now. I hope it continues. On the mining side, we obviously had I think PGMs will continue to run a slight underweight on PGMs. We've closed our gold position, and we are going to increase, obviously, potentially some gold ETFs within the overall asset allocation. We do think gold at nearly $3,000, with what's happening geopolitically, we do think central banks will continue to underwrite quite a lot of gold purchases. So we do see gold potentially going up for many, many years. But our gold companies are obviously very risky. I think Abel talked about one of our gold miners where you have to go in 4 kilometers into the ground. And what is fascinating about that company is 4 kilometers in, but the grade is now the highest that they've had since the last 40 years of mining, which is sometimes we tend to be lucky and we'll take it. So gold shares, we are neutral, but we are overweight through the ETFs. I think, yeah, retail, comfortable. Properties, we think it has rallied quite a lot. It rallied too hard, too soon. So there you need to be cautious. We don't think you're going to get interest rates. I think anyone who thought interest rates were going to be cut by substantial amounts this year, it feels like you need to halve or reduce your expectations. So that's our position there. And we like nominal bonds. I think the nominal bonds continue to offer lots of value. Thank you.
Yeah, so Matt, if I can maybe jump in again. I think if you look at the JSE delisting theme, which we've all spoken about at length on multiple occasions, which is obviously a negative. Asset manager wants less opportunities to look at. But if you actually look at the market cap of the JSE over the long term, it's actually done pretty well. I mean, look at it relative to the long-term history and long-term returns, and that's telling you that some of these large multinationals, the Naspers, the Prosus, the Richmonds, et cetera, have actually done well for SA investors and actually served them well and provided good real returns for investors. So for any local manager, in our mind, you need to be invested in some of those opportunities, and that's obviously part of what we do. I think we're quite fortunate where we are in our life cycle. Like Delphine, Ashburton's got 160 billion rand of assets, which is not a small asset manager, but within the equity side of the business, it's a new evolving space. So we brought in a whole new team, new skills, and so we're still pretty small on the equity side. So we've got a lot of flexibility. If you look at the benchmark, the cap Swix, I think for companies with a market cap of less than 20 billion rand, about 6% of the cap Swix is made up of
Yeah.
companies of that size or smaller. And if you look at our fund, we've actually been able to amplify our exposure to that end of the market where we think there's a lot of mispriced opportunities, and we've got about 25% of our portfolio in companies whose market caps are less than 20 billion. So I think we're definitely not ignoring large cap. We own a lot of large cap, a lot of the banks, et cetera, where we see value. But on the side of that, we're leveraging that mispricing and the arbitrage opportunity in SA mid cap and small cap. Because of our size at the moment, we can do stuff that our larger peers can't do at the moment, just by virtue of liquidity. So that's how we think about it.
Thanks. I mean, and then, SA investors have typically had a value bias, and what we've seen is growth outperform value, particularly offshore and abroad, and our market still offers a lot of value if you look around. Do you think that the SA mindset is still sort of value with a value bias, the SA investor, or do you think that's it's changing as they start to try to manage a domestic portfolio and a global portfolio?
I think maybe I can go
Yeah,
first.
go first.
Delphine is a value manager.
She's the last remaining one.
She's the last remaining one. So I think we've seen when you have a strategy that hasn't worked for nearly 10 to 15 years, you're going to get some people changing. So I think we haven't seen. What has happened is that obviously those who were deep value, we've seen their assets almost nearly decimated over the last 15 years. And you've had some value managers who adapted or evolved. So inherently they are still value, but how they look at opportunities, they've sort of enhanced their investment process. Globally, we don't see a lot of value managers. I mean, I do speak at conferences in the US. Most of their mindset it's focused on growth. And hence, you will see price to sales numbers, that multiples that are weakened. If you're a South African investor, you will not pay a price to sales of 50, 20, 100 times. But you go to the US, people are willing to pay that because they just only see the growth and the blue sky. So I do think if you look at home, there will be a time when value does exceptionally well. And if you look at the current cycle where we are in, where interest rates have largely normalized, you now have at least Operation Vulindlela sorting out the issues we had in Transnet and energy. You've had a change in government, which seems to be a lot more business friendlier. And as long as we can create an environment where our mid-cap companies start to thrive, start to compete, you will see that part of the market starting to do well. Remember, and I don't want to say it was doing badly, because if you look at a lot of them, operationally the companies were doing well, but they were just not rewarded through the price action. Because you have no one, there was literally, it didn't matter whether your EBIT was doing well or your operational profits were doing well, but if you don't have anyone from the sell side or buy side looking at you, there's simply just no price discovery. So I do think for this year, I'm hoping, as much as the US maybe doesn't, it seems like there are issues there, but I do think we have a great opportunity with the G20 this year to also make sure that we expose our companies to those who are in the country currently, and hopefully, as long as we can get foreign investors into our country, we may see some price action starting to come back to the market. But we've had a structural issue due to...
Sure. Very much support what Kabelo is saying, but there's an interesting perspective, because I guess on this that I have, which is, your point, Matt, was that SA investors have a value bias. And actually, I think it's not that the SA investors have a value bias per se. It's that the SA equity market is a value market. So the work we've done is that if you just take, if you just use the equity market of being the cap Swix as a proxy, and if you just take the cyclical stocks and you take the interest rate sensitive stocks, so your banks and your cyclical stocks, or your typical stocks geared to the consumer cycle or the economic cycle, and you take the commodity stocks, you get to about 55% of the market.
Yeah.
That's just purely on a thematic. Then you add in SA defensives, you've got another 10%, and then the remainder of the remaining 30-odd% is global defensive, global cyclicals, and global growth, effectively. And so it's actually that our market's a value market. And so
Yeah.
what that means, because value is often tied, the value style is tied to the mean reversion, the fact that you can buy a stock below its fair value. Why does that happen? Because a cycle is low and then the cycle recovers. You are still looking for compounders. And so what happens is that we've been all kind of pushed into having to understand stocks through a cyclical lens, through a cyclical value lens. And so where's the growth? I mean, I mentioned Capitec earlier. Where are the stocks of the Capitechs of now, or the Aspens of 20 years ago, or the ShopRites when they were small? We haven't got that in our market. So it's not that South African investors don't want to seek out the opportunity of finding unrecognized growth. When we can, we absolutely do. It's that there's the market construct of what is available in the listed equity market. So it's understandable why large allocators like the PIC are going into unlisteds, because they can find more growth there. Is not available. And interestingly, so what happens is that as you can't find the opportunity, managers have to defend their business models. Buy-side managers have to work out, well, how do I not get fired, right? It's like the intrinsics of the business risk is, existentially. And so if you go back, and in fact there was one of the large, I think, multi-managers that did this exercise, and you go back to just at the point of the tech bubble, and you went to all the websites of all the largest managers, and you just looked at their philosophy, and they all call themselves growth at a reasonable price. In fact, value was a very rare word. And then you fast forwarded 10 years, and value, the market was, 7,000 in 2003 on a 8 multiple and a 5% dividend yield. It was a pure value market. So everybody shifted into it. You bought cheap assets, and then it went up dramatically over the next decade. Went to the same websites, and guess what? Everybody was value, because that value was the style that worked. And now what's happened in the last decade, to Kabella's point, the value thesis has worked. It worked a little bit at the beginning of the 2010s. Definitely did not work. While Naspers was killing it, and in the last 5 years, it's come back dramatically, particularly post-COVID, because the whole market was value. And all the managers, multi-style, style agnostic, this style, non-style, because it doesn't make sense to put yourself in a box, because you're going to get fired one way or the other because of a labeling. So for business risk reasons, we're just going to call it, managers are going to call themselves the thing that is going to say, we will do something that makes common sense. We'll be common sense investors, we'll be style agnostic, and when the opportunity arises, we will go there. And you can understand why buy-siders do that. So there are very few managers that today on their website say, we are like value investors, although that's just the most common sense thing to do, to be honest. Who wants to buy an expensive asset? Just because you think it's going to go up, unless you have a thesis of growth. So if you can find that asset priced and you think it's a compounder, by all means, pay a fair price, because it's going to compound for you.
But we have to also remember that growth is a massive component of value. I mean, if your company is not growing on a real basis, you're destroying value. So it's impossible to disentangle growth versus value. So, on occasion, we will buy a stock that may be classified as a growth stock, but where we believe that the market is mispricing that growth. So exactly that, what I agree. And I think also the other thing to think about in the global context, that you've been through a decade of ultra low interest rates, and by virtue of that, anybody that's run a DCF knows when you put in a low cost of capital or opportunity cost, you're going to spit out a very much higher value. So by implication of that is that there's higher duration stocks, and your higher growth stocks are going to do a lot better in a very low interest rate environment. And now, as globally the interest rate regime is now normalizing, I think you're going to see a little bit more sanity come back into how people look at things and valuation, etc. So a little bit of context there as well.
We'll move on to the floor and see if there's any questions from the floor or from the audience. If there are none, I've got one last question.
You've got a question at the back there, I think.
There we go.
There's a hand popped up.
Greetings to the panel. I have a lot of questions, but I'll try and ask as few as I can.
We can hear.
Can you hear me?
Now we
Yeah,
can.
now we
okay.
can.
Oh, okay. Now, I was saying I have a lot of questions, but I'll try and ask as few as I can. First question is regarding what was mentioned at the beginning, and I'm just going to touch on what Abel had said, that, we need to make ourselves attractive. And I think Gabelo had mentioned originally that what we're faced with right now is that our market is shrinking. And as the market is shrinking, we also have this problem where growth in the economy is not looking good as well. Now, what I'm trying to understand is, from that perspective, particularly with the PIC, if you're still looking outside of South Africa, are there any things that you guys are doing to counter that effect, to ensure that even for foreigners, if they're going to be coming into our country, there is some attraction points that they are looking at? There are companies that, they can invest in, because currently, right now, that investment universe is very small. So are there active things that are being done to actually help elevate or reduce that crisis that we're facing at the moment?
Yeah. Should I go?
Yeah, I think it's for you.
Okay.
I have a comment, but you go first.
I think maybe just to be, so we need to optimize the returns for our clients, but what we are conscious of is that we want a thriving listed equities market. So while at some point we may see opportunities on the unlisted side, but quite a lot of the work that we are doing is to make sure that companies that are doing well on the unlisted side, we are trying to make sure that we have what we call value creation plans for them. And essentially, our key exit strategy is to list most of those businesses. But you need to get them to the right size so that you don't list something that no one else is going to look at. So even though there is quite a lot of activity on the unlisted, but remember the key exit strategy, it's either to a strategic, but our preference will be to IPO some of those businesses. And some of them have been names that you already know. I think there has been announcements on some of them. So that's the key. We do think without having a thriving listed equity market, our whole capital markets is not going to do well. But you have to just do what you can given the current circumstances.
The point that I would add is that, so what's currently happening is that the South African listed equity space, all the industries and the sectors within it, because their pie is not growing, it ends up being a market share game. So we tend to be, as analysts or as investors, we're sort of trying to work out who's the winner, like it's a winner-loser in a tough market share. But actually, when you sit with all the company management teams, they all actually, most of them have lost their shirts in every other country they've gone to. It's really never worked out well, the domestic players. But they actually want to invest here. They just have not been able to pull the trigger on capital investment, whether you're in the food value chain or rolling out things in industrial, and it's largely been because of the uncertain policy environment. And so what has happened, as you've seen, whether it's been the investment industry or whether it's been corporate South Africa itself, whether it's with the regulators, et cetera, really trying to create certainty and priority about policy delivery, execution, because we do know that South African companies who have large amounts of capital to invest want to invest it here. They can actually see the return. This is a low consumption per capita GDP consumption market with a long kind of visibility. If we could increase consumption on virtually every category, we're a young population with great demographics. If we could get the employment in, this is the best place to actually invest for a lot of these companies. If they could get certainty over, are we going to have no load shedding? Can I get fiber to my companies? Can I get water, etc.? So those are big things to fix, but our sense is that ironically there is a huge appetite to deliver and execute on expansion here, as opposed to doing it in Switzerland or Ireland or Australia for the same good companies if they could have that environment. And I think more people now have a voice around ensuring that that's a priority.
Yeah, I mean, if I could add, you know, if you saw the ECM space last year, it was a fantastic year in the equity capital markets. So we had record transactions in terms of placements. We had a very large IPO. There was a number of, like I say, corporate actions that increased liquidity in the market, and those were very well supported from the buy side, both from domestic and internationals. And I think that if there's a pipeline, you know, and obviously it's reliant on a market window, and that window is open, so there's a pipeline at the moment, you know, of companies that want to come to market, of transactions that still need to go ahead. Anglos has announced, you know, the Amplats unbundling. So there's a lot of exciting stuff in the space. You just require the confidence in the market and let's say that window to be open. And at the moment it is. So let's hope we continue to see that ECM activity into this year. Are there any more questions from the floor? We'll take one last one because we're out of time.
He isn't allowed to ask a question.
He's going to ask you.
Just here on the front here.
Slebo.
Thank you to the panelists. Kabela, this is directly to you. I think going back to your conversation around your allocation, sort of global versus local, maybe the question to you is, do you believe that if your organization, because you obviously represent, call it direct and allocating indirectly, do you believe that if you allocated more indirectly, you know, to the asset managers, that could, in a way, drive more activity in the market? And if that's the case, what is the strategic intent of the PIC in that regard? It's the question that I know Delphine and Charles were going to ask you anyway.
Okay, yeah, so Lebo, there are many ways to skin a cat, and how we are doing it is that on the unlisted side, or even on the listed side, there are certain things I said on the listed side which we want to get the likes of your Delphine and other companies to do it for us using a multi-manager platform. I think that platform on the listed side is about, I think we've allocated about just under 600 billion to local asset managers. My only concern with it is that most of it is just domestic equity. So we need to then move it to bonds, but we also need to move it to offshore. And that's a process that we want to continue with. On the unlisted side, we have a fairly sizable team, but there are certain sizes of transactions that we will never get to, or there are certain parts of the market which they will not come to the PIC asking for money, but if you allocate it to a third-party asset manager, they can go and look and get a good company for you. I think maybe just as an example, if you think of logistic businesses, if you want a high-quality logistic business today or a logistic real estate, you will not find it. Well, they come to the PIC requesting capital, they don't need the capital. But if you get a jockey who can then go and convince the shareholders of that structure on your behalf to access that asset, that may work. So there are things that you need to realize that you can't be competent in everything. There are certain areas where we want to partner with our local asset managers and others, and we allocate. So much larger transactions you will find us doing ourselves. When we bought into Tech or Awick, the waterfall investment company, that we did it ourselves. It was a big check. It will take you a year or 14 months to close it. That you do it yourself. But there are certain deals, high-quality deals, that require you to act with speed. And unfortunately, there you then use your other asset managers. They are quicker, more nimbler, but it achieves the same thing. But the other thing for us as the PIC is that we have a duty to the South African financial markets industry in totality. So we want a thriving capital markets. I think I sit on a panel, not on a panel, but I've joined a task team that's run by the JSE and with some other business people to see how do we help the National Treasury and our government in improving our capital markets. And there are lots of work streams in the background. But I think you have to try everything. There's no silver bullet.
Thanks. I'd like to take this opportunity to thank our panelists, Delphine, Kabelo, and Charles. It was very insightful, and thank you for the participation.
Thank you.
Thanks, man.